Hello friends, I welcome you all in one more knowledgeable interesting video. Today in this video, we're going to talk about some common mistakes in tax audit report and how to interpret what actually clause of form 3CD required, right? And what information we need to submit, right? So I'll be sharing some common mistakes that I observed in during preparation of form 3CD. First, talk about section 43B reporting. Right. There is a clause in the tax audit report that requires reporting of section 43B payments in a clause, right? So here the common mistake is that TDS payable should not be reported in this clause, right? Because TDS payable is not a P&L item. It is not a deductible item in income tax. Rather, TDS payable is a balance sheet item. It is not a P&L item, right? So if it is not a P&L item, there is no deduction available for TDS payable. Then how it is to be attracted by section 43B? So it should not be reported in the relevant clause, and section 43B says that there are some expenses deduction for which is to be allowed on the payment basis, right? So do not report, please take care of this, do not report TDS payable under clause that requires reporting of section 43B items, right? So this is first. Second important aspect is that there is a clause in form 3CD, clause 21A, which talks about reporting of penalties and fines, right? Now here important aspect for reporting in this clause is that, see, there are two items that you can see in majority of the financial statements. First is interest on TDS, right? Next is interest on delay payment of GST, right? And GST late fees, right? If you see these three items in the profit and loss statement, the income statement, then do not report these three items amount in clause 20A, because these are not penalties or fine. This is not a penalty. This is not a fine. What is penalty as per clause 21A, or what is penalty as per Income Tax Act? Penalty is something which is paid for contravention of any law, right? Interest on TDS, interest on GST, and GST late filing fees was paid by the company, right, or the SSE, just for buying more time for the payment. It is not in contravention of any law, right? Why we pay interest on TDS, interest on GST? Because maybe at that time organization or the SSE is not having money to make the payment, right? Maybe the organization or the SSE requires 10 days, 15 days, 20 days, or a month more for making the payment, right? There is no problem in that. Just pay the interest and make the delayed payments. So what you are doing is you are buying more time. So this is not in contravention of any law, right? So this is not a penalty or fine which is to be reported under clause 21A. So do not report these items under clause 21A, right? Next is, third item is that the reporting under clause 21G of 3C, which requires reporting relating to contingent liabilities, right? Contingent liability reporting is to be done under this clause, right? See, if you see a financial statement and when you look at the notes, right, and you find any contingent liability is there, then this is to be not reported under clause 21G of 3C, right? See, actually clause 21G of 3C talks about the details of a liability which is in the nature of a contingent liability, right? Means the liability is there in the financial statement, liability is there on the liability side posted in the balance sheet, right? And that actual liability which is posted in the financial statement on the liability side is of the nature of any contingency, which is based on any contingent event. So income tax department want detail of that liability, right? Department do not want detail of the contingent liability which is disclosed in the notes to the financial statement. That is clear, that is based on the contingent aspect, but department is more interested into actual liability which is based on any contingent event, because the liability may arise because of the expense booking, and that expense booking payment is based on any contingency. Organization or the SSC have to pay or may not have to pay. If organizations may not have to pay, then the expense have to be disallowed, or either the liability should be treated as unexplained credit, right? That the future would tell that what instance the department would take in assessment proceedings, but clause 21G of 3C talks about the actual liability which is in the nature of a contingent liability, not the contingent liability which is disclosed in the notes to the financial statement. So please take care of this. Next item is, right, that we found common mistakes in that is, right, in clause 20B, one of the most discussed and one of the most painful clause of tax audit report that requires compliance, that requires reporting of payment of employee contribution. Please take care. What is needs to be reported is employee, right? Not employer's contribution, right? Department have nothing to do with employer's contribution, right? Reporting is required only for employee contribution. Either it is PF or it is ESIC, right? It is employee, not employer contribution. So please take care of this aspect also. Clear? And the next important aspect is that after judgment of the checkmate of Honorable Supreme Court of India, everything is clear that it has to be paid on or before the due date. And what is the due date? Is the 15th of the following month. If not paid, then it has to be reported and disallowance will be there, right, at the time of intimation of income tax return, right? So the due date is 15th, and please also note here that there will going to be no grace period allowed. No grace period is now allowed in this, right? So the law is very much clear on this, right? The first thing is that employee contribution needs to be reported, but not the employer contribution. No grace period. 15th is the due date for payment, right? So please take care of this. Now next is very important aspect, very, very important, right? For example, if as a tax auditor, your appointment is made after 31st of March, right? Then please report this fact in the tax audit report that your appointment is made after 31st of March. So you fails to physically verify inventory, cash, or fixed assets. You fails to physically verify inventory, cash, and fixed asset because your appointment was made as a tax auditor after 31st of March, right? So you have not physically verified inventory, cash, and fixed asset. Please clearly mention this fact in your tax audit report, right? Now, it depends on your professional experience, professional knowledge, judgment, that how you report, right, genuineness, trueness, and fairness of this inventory, cash, and fixed asset balances as mentioned in the balance sheet on 31st of March. But if you are appointed after 31st of March, then this reporting is a mandate, right? So this video was all about some important 5 aspects, right, of common mistakes in tax audit report, right? So if you have any query relating to tax audit or any of the provisions of Income Tax Act, right, you can post your query in the comment box. We will try to reply to your query as soon as possible. Like this video, subscribe to the channel if you would like to have notifications for all the upcoming videos relating to taxes. Thank you. Thanks a lot. Stay connected. Again, I am saying subscribe to the channel if you have not subscribed to it. Thank you. Thanks a lot. Bye.